Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about financial modeling. There's a growing number of businesses, particularly in the property space, so buyer's agents, for instance, that are offering financial modeling as part of their service. And so it's not uncommon to go and see a buyer's agent and they'll come up with a financial model of how you can go out and buy 2 or 3 investment properties. And the financial model will model out or project forward, how your cash flow might change as a result of doing that and how your net worth might change as a result of doing that. And so that makes it easier to visualize how a strategy can play out. The problem, though, is financial modeling can produce almost any result. I mean, you can manipulate the assumptions to really produce any results. And so what I want to do today is talk about how modeling is used, not only for buyers agents in the property space, but financial planners use modeling as well. And that can be just as dangerous. And really what we want to understand is, can we use financial modeling? When is it used as a tool to provide and formulate advice versus when is it used just to produce a sales pitch? And that's what I really want to talk about today. So let's start with a little bit of a history lesson, which I've told before, but one of the financial planning industry's longest running failures is dressing up product sales as advice. Now, that ended when commissions were banned back in 2013, so some sort of 12 odd years ago. And it was really one of the best decisions that the Australian government ever made, was to ban commissions. And it's probably why the ETF industry has grown so substantially. Back in 2013, there was about $7 billion invested in ETFs. Today, it's over $330 billion. That's a huge amount of growth over a 12-year period. But really, if we cast our minds back before 2013, it was common for clients to seek out advice from financial advisors, expecting some sort of strategic guidance or a strategic plan, only in reality they were being sold a product that earned that advisor a commission. And that mismatch of and misused trust created a lot of problems. Most of the problems were for the client, of course. So not only did it result in probably a disappointing investment because, of course, the client's paying for the commissions, those products were high fee environments, but also there was a mismatch of expectations where the client thought they were getting honest advice, strategic advice, but really they're just being sold a product. And really in some environments, that's okay. Like if you walk into a used car yard, you're going to be sold a used car. The goal of the salesperson is to sell you something. So you go in there sort of buyer beware, if you like, but financial advice shouldn't have to work like that. Before 2013, it absolutely did. Today, you remove commissions. It doesn't necessarily have to work like that. So what I'd hate to see happen in the property sector is for the property industry to repeat the same mistakes, because that's just going to destroy trust in industry, and it takes a long time for an industry kind of regain that trust with Australian consumers. So what I'd hate to happen here is for people to go out to buyers agents, feel like they're getting an investment strategy, but really what they're buying is the idea of paying this buyer's agent to go out and buy them 2 or 3 investment properties. So therefore it's important, I think, for everyone to understand the limitations of financial modeling and how to dig a little bit deeper and understand, am I getting a sales pitch here or is it advice? And in order to do that, I think the first and most important thing to understand is that in financial modeling, assumptions drive outcomes. So if you want a particular result, you can usually get that result simply by changing the assumptions and the numbers, fall into line. But there's an added incentive as well, because if the modeler gets paid when you transact, then of course the model is naturally going to be, structurally biased towards optimism rather than being conservative. And secondly, if the person that's doing the asset selection is also doing the financial modeling, then of course there's a conflict of interest here as well, because if I'm a buyer's agent, for example, and I'm going to go out and buy an investment property for you, then I don't want to use modeling assumptions that are conservative, because naturally you're going to question, well, why should I pay you this big fee to go and buy this property when you're only assuming 6% compounding capital growth, for instance? So there is that conflict to make sure that the returns look attractive in the model. The assumptions that I'm using within that financial model look attractive because I'm the one that's doing the buying. I want you to use my services, my buying services, to implement that strategy. Now, that conflict of interest exists in the share investing world as well, but to a lesser extent, I think, because if I'm looking at an ETF or investing in a particular geographical market, then I can point to a huge body of evidence that will tell us how has that market performed over a very long period of time. And then if I think, well, that's the sort of base return, my assumption then to deal with volatility, which I'll talk about in a second, is to then something more conservative than what has actually happened. So on that basis, you can kind of back it up. But where asset selection is the big thing here, whereas in share market, particularly if you're using evidence-based strategy I talk about, it's more about indexing. So certainly asset allocation is an issue, but it's not really, doesn't have the same conflict of interest, if you like, because whether you invest in one ETF or a different ETF, I've got no vested interest in the outcome as a financial advisor. But anyway, the key point here is the assumptions are critical, and the person that determines the assumptions, you've got to, assess their independence in being able to do that. So I think high quality assumptions are conservative, but not so conservative that they become meaningless. So there's no point assuming, an average interest rate of 10% if there's no chance of the interest rate being on average over a long period of time, 10% in Australia, which I don't think it is, right? So that's being too conservative, where it starts to manipulate the potential strategy you might employ if you're going to base those decisions on unrealistic interest rate expectation. So I think the answer is that for all assumptions, we can tend to build a reasonable expectation range. So for example, if I'm going to use the interest rate one example again, you might say, I'm going to assume interest rates are going to be between 5 and 7.5%. And for some assumptions, it might be quite a tight range, or for other assumptions where there's high level of uncertainty, maybe the range is wide. 5 to 7.5% is relatively wide, of course, but you might say, look, it's between that range. And therefore, I think the right approach is not necessarily to be on the most conservative end of that range, but towards the conservative end of that range. So if I'm doing some financial modeling, I might assume an interest rate of, say, 6.5% and stress test it at 7 or 7.5%, for instance. So you still want to make the financial modeling as meaningful as possible, but you still want to build a level of conservatism in there. And most importantly, it should be evidence-based. So if I go and have a look at the time-weighted average of interest rates over the last 20 years and the last 10 years, the last 5 years, build a different data set of different points that I'm looking at so that I can come back to you and say, well, this is what, we're going to use. So for instance, what we do in our financial model for interest rates is it's all based off a cash rate. So we add a margin on top of the cash rate, whatever that margin is at a particular time or whatever it's historically been in terms of how home loans are priced or investment loans are priced. That way, what we need to determine is a cash rate assumption. And that's relatively easy to do because the RBA, which obviously is completely independent, talks about what it thinks the neutral rate is, the neutral cash rate is, and that's really the best rate to go off. So the RBA thinks it's close to sort of 3.5%, and so that seems to be a pretty good assumption. Now, sometimes in the first years, if the cash rate, the prevailing cash rate is above 3.5%, we'll build that into the financial model too. But if we're modeling out over 30 years, we'll use a sort of neutral cash rate level. But again, I can point to say, well, we're being a bit conservative here in terms of the benchmarks over and above the cash rate that we're assuming. And, whilst the RBA might say we think the neutral rate is between 3 and 3.5%, we'll always pick 3.5. We'll be on the more conservative side. But the key thing here is I can point to the evidence of why I've assumed that, made that assumption. And I can also point to the evidence to demonstrate that it's on the conservative end of the assumption range. Look, and the other thing to be wary of, and this is where being asset class agnostic comes into it, financial modeling can be advice, particularly in scenarios where I've modeled two different combination of assets. So I've modeled, for example, going and buying one investment grade property and then building a share portfolio in a family trust or in the lower income spouse's name or whatever it might be. And I've compared that strategy to going out and buying two investment properties. But if the financial modeling only considers one asset class, so all shares are all property, then to my mind, that starts to look more like a sales pitch rather than necessarily holistic advice, holistic and asset class agnostic advice. Now, you can't take that to the extremes. There's going to be some situations where, in fact, we as a business might not model investing in property because of client preferences or because of particular circumstances. So it's not an absolute observation, but it tends to be, if we're only looking at, one particular asset class, that can be a signal that it's more of a sales pitch than strategic advice. Now, the next challenge with financial modeling is that returns are never straight line. And I guess we as investors, we all understand that, right? We all understand that we can't go and invest in a particular asset class and every single year we're going to get 7%. We know markets just don't work like that. But the whole benefit of financial modeling is what you're trying to do is work out, well, if I take these actions over the next couple of years, how will it work out by the time that I'm retired? And so if you're in your 30s today, we're talking about a 20 or 30-year time horizon that we want to measure the impact of those decisions out over. And that's really what you're trying to do. So you don't end up in your 60s and think, well, in my 30s, I should have taken a different approach. You've lost that opportunity. That time's gone now. So when we're financially modeling, investment returns, of course, are a very important assumption, but we have to acknowledge that returns are completely random. So I don't know how they're going to be received over the next 30 years. I can certainly work out a mathematical average, but the mathematical average doesn't deal with the sequencing risks. And this is where the tension lies in financial modeling, because we know returns can be uneven or sporadic or all over the place. But yet, if we're building a long-term financial model, we have to make a long-term assumption with respect to investment returns. I mean, as you can imagine, if you invest just before a market crashes and say like the GFC, it takes many years for the market to recover, well, all of a sudden the first year of your investment experience is maybe a 30% loss of capital, and then subsequent sort of 5 years just to recover that capital. So you've got no returns over the first 5 years. Of course, from a compounding perspective, if we assumed you were going to receive 7% a year as a long-term average, you'll be well behind the 8 ball in terms of where we expected you to be from a financial modeling perspective. So how do we deal with this? Well, there's two factors we tend to consider. The first one is our best way we can accommodate the risk of volatility in returns and sequencing risk is just to be conservative with our long-term average return. And this is not a magic bullet. You're still going to have some risk as a result, a sequencing risk in the financial modeling, but it is a good way to deal with it. So for instance, if we look at what is the average return over the last 40 years, 45 years from the Australian market, from the MSCI World Index, whatever it might be, typically we'll find that the average returns are around about 10% when you look at different indexes. They don't vary that much. So if we think, okay, the long-term average is 10%, we're going to assume 7%. And the 3% differential, the 3% delta there is just our way of kind of accommodating sequencing risk, that if we do happen to achieve a lower than average return in the first decade of that investment strategy, that at least by being conservative with the remaining 20 years, we'll make it up. And whilst we might not make it up, at the 15-year time frame, at the end of the 30-year projection period, we'll be round about where we expected to be. The other consideration is if my strategy is premised on the idea that I'm going to enjoy strong immediate returns or above average immediate returns, it's a bit of a red flag. So for instance, if I'm modeling, let's go and buy an investment property and we think we can buy this property and make some improvements, and we think that we're going to buy in an area where the momentum is really strong, and in 2 years' time, we reckon there's going to be enough equity in that property and we're going to have enough borrowing capacity to be able to tap into that property and buy a second investment property. And in order to do that, what the model is assuming is that we're going to get, 12% growth in the first 2 years so that we're able to extract that equity and get the second investment investment property. Now, I'm just throwing these numbers out, right? It's just an example, but you get the sort of theme. In that situation, it might start to look more like a sales pitch than advice, because I don't think I'd ever model a scenario like that. I'd want to come up with a strategy that what happens, okay, we'll buy this property if we think it's a great property and it's investment grade, etc., etc. But we don't know how returns or how markets behave, particularly in the short term, really difficult. So we don't want a strategy to fail just because we didn't get the returns over the next 2 years that we expected. Because to me, that's not a strategy, that's a hope or a wish. So when coming up with a strategy or modeling out a financial strategy, being conservative, but not so conservative that it becomes meaningless, but being conservative with the return assumptions is really the best way to deal with the fact that no one really knows what the market will do in the short term. And in the short term, returns are wildly unpredictable. Over very long periods, like multi-decade periods, of course, they're far more easy to predict. But what we're trying to do is model out or build a long-term model, not really predict what markets are going to do in the short term. And we don't want how markets behave in the short term to completely drive or upset our strategy. Now, the next observation I wanted to share, or experience over the last 20 years I wanted to share, is it's easy to overestimate property cash flow. Something that I've really, witnessed myself personally and professionally, and just generally in the market over the last couple of decades or more. So, for instance, a few years ago, I recorded an episode about how property costs have risen. Things like insurance, as in property insurances, council rates have increased, of course, interest rates have increased a lot over the last period of time. Property management fees, compliant costs have increased as well. Getting smoke alarms checked, a gas check, electricity check, all these sorts of compliance things that have jumped in. And what I concluded a couple of years ago, of course, the link is in the blog on the show notes. The link to the blog is in the show notes, and I've got a link to that episode as well on the blog. And what I concluded is that now what we're doing within our business, we're assuming that the direct cost to hold a property, excluding land tax, between 30 and 35% of the gross rental income. Where previous to that analysis, we were using 25% for a long period of time. So it's really easy to underestimate. I mean, we've just had COVID and there's been a lot of inflation during COVID, of course. But if we had a look at, our modeling of investment properties that we did, say, 15 years ago, we've learnt the lesson that it is easy to overestimate how a property's cash flow might improve over time. Now, if you add to that land tax and how land tax regimes can change and how land valuations can change that drive changes in land tax, of course, that just adds another level of complexity and unpredictability with respect to future cash flow. And the whole idea is that, that your interest costs pretty much stays the same. Of course, interest rates change, but the principal loan balance is fixed, and so inflation kind of eats away at it. But over time, your rental income climbs because general inflation obviously pushes rental incomes higher. And so if your costs don't rise as much as your income, particularly in percentage terms, your property's cash flow improves. And if you hold it long enough, it will eventually become positive cash flow. And that's when the total rental income pays for all its holding costs. And this is where the big assumption comes in, is how much will your property's rent increase by? And a lot of financial models assume that the yield will hold constant. And so therefore the implied assumption is that your rental income will increase just by the same rate as the capital growth rate. And so if we're assuming a 7% capital growth rate and a fixed 3% income yield, then what we're really assuming is that our rental income is going to increase by 7% per annum, which is a pretty aggressive assumption. Now, of course, your rental income can only increase by the amount that a renter is able to pay for rent in that particular location for your type of property. Rental yields and rental amounts, costs can't increase more than someone's income. I mean, they can for a short period of time, but not perpetually, of course, because obviously renters tend to be, in a weaker financial position. They tend to, as a general rule, have lower incomes, and they're going to be more sensitive to changes in rental expenses. So if you look at how incomes in Australia have changed over the last few decades, they tend to increase by around 2.5% to 3.5% on average over a long period of time. And in investment grade locations, rental incomes can increase at a faster rate than that. When you look at how rental yields have changed, so, how much the median house is achieving in Melbourne, Sydney, Brisbane, and so forth, over the long run, they've tended to increase around about just a little over 4%. So really, I think that's your range that you need to work with. You've got to assume that rental incomes are going to increase by 3 to 4% per annum. And so if they do that and your capital growth rate is assumed to be higher than 3 to 4% per annum, then essentially what it's saying is your percentage yield relative to the market value will decrease over time. The point is that's a key, if you haven't followed that argument, I know it can be a little bit more complex, but essentially what I'm saying is that a key assumption with respect to forecasting property cash flow is how much will the rental income increase by? Because to predict overall costs and to predict what interest rates might do over long term, that's relatively easy. The missing piece of the puzzle is how much the income will increase by, and quite often that can be overestimated in a lot of financial modeling. And that's cause for concern, right? Because if you're an investor, you're going to buy a couple of properties today and retire in 20 years' time, and you look at a very optimistic model, by the time you get to year 20, your property portfolio is generating quite a healthy level of income net of all expenses. But if in reality it's not, and if in reality it's still negative cash flow, then that poses a problem because you don't want to go into retirement with a ongoing commitment of managing these properties from a cash flow perspective. You actually want to go into retirement and hopefully they're neutral or slightly positive. So again, being conservative with these numbers helps you build a strategy that's actually going to work rather than, set of projections. They're mainly to sell another property to you. The next thing to consider with financial modeling is execution risk. So it's great to develop a strategy in an Excel spreadsheet or in some sort of modeling software, but if you can't execute it, the strategy is worthless, of course. And that's what execution risk is. How easily can I execute this strategy? If it requires me going out and borrowing a whole bunch of money to go and buy 3 properties, is that doable? If it requires me to buy another investment property in 3 years' time, do I expect I'm going to be able to do that? If it requires a certain amount of cash flow to go into super each year, am I able to, find that cash flow to be able to put into super? This is not just all about property, of course. Financial modeling is used across the board by financial planners and also buyers agents. But with respect to property investing, the ones that I've seen that's kind of fall over is that it's great in a spreadsheet environment to work out, okay, this person's going to do this and we've made these assumptions on their living expenses, tended to be really conservative, but it's all about borrowing capacity. And if the person doesn't have the borrowing capacity, then they can't implement the strategy. Now, of course, borrowing capacity can be influenced by things like interest rates, credit policy changes, things like the interest rate buffer, living expense scrutiny, high debt to income sort of caps, these sorts of things. But also it can be impacted by changes in your personal circumstances, of course. So the first thing that I look at when I see a strategy, see a bunch of financial projections, is I ask myself, how tight is the borrowing capacity in this one? And if you need everything to go right for you to be able to implement the strategy, then execution risk is high. If the strategy is somewhat conservative and you feel very confident you're going to have more than enough borrowing capacity to be able to implement the strategy, then the execution risk, at least on the property side, is likely to be towards the lower end. And so this is something to really think about when you're presented with a set of projections, to really ask yourself about those questions and really interrogate those projections. A really good example of how this execution risk plays out is interest-only lending. 10 years ago, it would have been a reasonable assumption for me to build a financial model where the assumption is that the investor would be able to keep rolling over interest-only terms indefinitely and would never be forced to repay principal interest. And we might be because of one particular lender, but we've always got the flexibility or opportunity to go and refinance to a different lender. Now, whilst that might be still true today for some clients or some people, it's not going to be true for everyone. And we know over the last 10 years, of course, there's been a lot of tightening with respect to interest-only terms. So then we've got to then consider what happens if we're forced to repay principal interest. What impact does that have to the strategy? Does it all fall over? We need to think about these sort of execution risks. So that's why it's important to think about not borrowing capacity over the next 2 or 3 years, but also borrowing capacity in the long run as well. We want to make sure that our clients have a level of borrowings that they take into retirement where they're not locked out of the refinancing market. So that is that they've got enough borrowings that they can still justify from a serviceability perspective on an ongoing basis. And therefore that if they run into trouble with their existing lender, or they want to shop around for a better rate, or they want to restructure their lending back to interest only or do something like that, they're not locked out of that market. And that's a key component in terms of the strategies that we produce to make sure that our clients are going to be in that situation. Now, of course, it's inherently difficult to predict what someone's borrowing capacity might be in 30 years' time, but it's not a case we want to ignore. It's still something we need to really think about because that really informs us around the execution risk. Now, the final point I wanted to talk about today was a sensitivity and scenario analysis. So a sensitivity analysis involves changing a few key modeling assumptions. So things like interest rates, investment returns, tax rates, capital growth rates, these sorts of things, and identify which variable or which assumption is the most sensitive. So which has the biggest impact on whether you're going to be able to achieve your goals versus not achieve your goals. Surplus cash flow, assumed surplus investable cash flow is one of those. And one of the factors that drive that is living expenses. So to sensitize living expenses, what happens if it's not $80,000 a year, we're spending $100,000 a year, what happens to the strategy? And by doing this analysis, you can really then drill down and go, what are the 2 or 3 things I absolutely need to nail here? So, for example, a lot of strategies that involved investing in property are quite sensitive to the capital growth rate. So, what growth rate do we expect the property assets to generate? And that will materially change the net wealth figure, in 20, 25, 30 years' time, whatever it might be. So if we know that that is a sensitive assumption, we know we want to absolutely nail the asset selection piece. Now, I don't need a financial model to tell me that, and you probably don't either if you've been listening to this podcast for a while, but it's just an example of how we can then identify, again, if a cash flow is really sensitive to investable surplus cash flow. And if we've assumed living expenses, say $110,000, then we know we really need to focus on that and have a high level of confidence that in fact $110,000 is a reasonable assumption, is a reasonably conservative assumption, I should say. If it's not, then we need to go back to the strategy and revisit it. If it is, then it gives us more confidence that the numbers are correct and that the strategy that we're going to employ is going to work as well. Similarly, if we find that borrowing capacity is very sensitive, that the strategy is very tight on borrowing capacity, then we know to be a proactive borrower is going to be key to the implementation of this strategy. And a proactive borrower is someone that's going to be more aggressively, measuring borrowing capacity, locking in equity, working with their mortgage broker. So in that situation, if we have a strategy like that, we'll bring the mortgage broker in very early on in the stage and help them understand what are the key things we need to do. And so, for example, we're working on a scenario like this with a client at the moment where we realized that borrowable equity for this client was going to be a really key thing. And so the client was saying, well, what can I do to improve that? And our answer was, there's nothing you can do. It's really up to us. And so we shopped around for some valuations. And so one for a property this client owns, one valuation came in at 1.3, another one came in at 1.5. And you might do those valuations again in 3 months' time, and the 1.5 one might be even 1.6, and the 1.3 one might go to 1.2. It can be all over the place. It's really just the proactiveness with respect to this, but the difference in those valuations makes a big material difference to that client in terms of execution, their ability to execute on the next step of the strategy. So understanding what are the key factors within the strategy, what is most sensitive, helps us as advisors really focus our energy towards those aspects and making sure that we implement and we manage them as proactively as possible so that the strategy becomes implementable and we can take what is a great idea, a great strategic approach, and turn it into reality. So financial modeling is incredibly important because it translates a strategy into an estimate of what the picture could look like if you followed that strategy. So it gives us confidence that yes, the strategy could work. If we did A, B, C, D, E, that in 20 years' time, you'll be in a position where you'll have the choice to work or not. So it achieves your goals. The second benefit of financial modeling is we get to compare strategy A with strategy B. What happens if we gear really heavily and aggressively into property, or versus if we're a little bit more balanced with respect to property and shares, and how do those two strategies compare in terms of financial outcomes? And then we can assess the inherent risk in both those strategies and kind of weigh it up to say, well, they both work, but one's much higher risk. So why would you take that strategy? So financial modeling is very important, but it's not an absolute verdict. You're not trying to predict the future. You're just trying to predict how the future might change if you take a certain set of decisions or actions or tactics over the next few years. So whilst financial modeling is a very important part of the process, it's also important to understand it's just a logical output of the assumptions that underpin it, and the assumptions are where the real judgment lives. So if someone gives you a financial model and they've got a vested interest in you acting upon it, then you've got to interrogate it. Don't just accept it on face value. You need to ask yourself, are the assumptions conservative and evidence-based? Does it survive a stress test for interest rates, borrowing capacity, timing risk, these sorts of things? Does it compare alternatives? That's a very important one as well. And if it survives that interrogation, then it's likely it's going to be a helpful tool. But if you don't interrogate it, then the risk is you're really buying an engineered outcome on paper, not really advice. Okay, I think I'll leave it there today. In the outro, I'll talk about my new book. And until next week, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it will take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.